Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We are coming to you as always bright and early from the CNBC-TV18 Motilal Oswal studios. Coming towards the second half or the latter half of the week, I'm Surabhi Upadhyay, as always with me, Nigel D'Souza. Today we have Rima in the house. Good morning, guys.
Morning.
Hi, good morning. Things seem to be calm, right? We've gotten used to so much volatility, so many headlines. But over the last few days, markets have been in a tight range. And we've been low on headlines.
Well, I think calm is not so bad, right? After
the storm.
Yeah, after the kind of news flow that we have had. So I think markets consolidate a little bit. Broader markets are participating as well. And gradually, after a while, you're getting that feel-good factor yet again. If you check your mutual fund portfolio, you check your portfolio on the whole, things are looking a little bit better than, say, a month and a half, 2 months ago. So we'll take that, I guess.
Oh, absolutely. And, it's also calm, I think, in terms of the market just digesting the level of news flow that we've had.
Yeah.
And the news flow continues to be fairly robust, especially when it comes to geopolitics. And that's also a watch point. So actually, let's get started by talking about what happened overnight. So what happened overnight was we had a continuation of the rally on Wall Street. However, it's becoming a little narrow. So slightly mixed yesterday. The Dow couldn't be in the green, but the other two indices did fairly well. The S&P 500 as well as the NASDAQ. They kept notching on the gains, and it's been a fantastic winning spree for US tech. That continued last night because the NASDAQ managed a gain of about 0.7%. And for the week, thanks to the mega rally that we are seeing in the MAX 7, that index is up almost 7% already. I mean, and that's just counting 3 trading sessions on the US market action. Now, why am I talking about geopolitics? Because there's a lot going on. Today, specifically, this Russia-Ukraine conversation is going to be in very, very sharp focus. Remember, we had Mr. Zelensky pretty much throwing out an open invitation to Putin, saying, let's meet in Istanbul, in Turkey. So those talks are slated. It's not very clear who will turn up and who won't. International reports are indicating that Putin himself may not come for these talks. But let's see. We'll have more clarity as the day emerges. But this is going to be one important watch point. Yesterday, the developments out of the Middle East were very, very interesting as well. And in fact, they left certain sections of the Western world perhaps shocked, if I can say. And this is the fact that the US is now lifting sanctions on Syria. Donald Trump yesterday met the interim Syrian president, Ahmad al-Sharar. This was in Saudi Arabia. There was also the Turkish president Erdogan on that call as well. So a lot of these shifting equations, trade and, geopolitical equations in the Middle East are also something that the markets are tracking very, very carefully. Now, let's come back to the action in the currency and the commodity space. The yields inched up yesterday. US 10-year actually moved up to about 4.5%, slight climb higher, 2-3 basis points higher. Today is an important day in terms of data point because the consumer inflation numbers that came out of the US are fairly benign. Today, we will have the PPI data, the producer price index. That's not all. We'll have the retail sales number and the industrial, production number for the month of April as well. That will give further direction to markets, including to yields. The dollar index has been range-bound. Yesterday, the dollar recovered a bit in US action. This morning, again, the index is on the back foot, as you can see. It's down a couple of basis points. The broad range this week for the dollar index has been about 100.5 on the downside, going up to 101.8. That was the peak that we've seen so far this week. So today, we are in the middle of that trading range. For India, it's been about consolidation when it comes to the large cap space, but the consolidation itself has a positive bias. There's no taking away from that. Flows are a little mixed, and, we've had a slightly patchy performance from the FPIs, but they haven't entirely gone away from the market, and we'll talk more about that as we go forward. The broader market up move is continuing. So it's telling you that there's that feel-good factor in the market. The market is willing to reward good earnings, and that's what we saw yesterday as well. And even today, we'll talk more about earnings as we go forward. We actually have some, decent surprises, Jubilant, Aisha, even Hitachi. So you do have some good numbers to talk about today as well. The only caveat here is the bank nifty, because we're not seeing a sustained pullback on that particular index, and that outperformance is something we need to watch. And that brings me back to the point on flows, because flows are patchy. And we have this question now. The key question for the market is whether there will be this near-term tactical shift by FPIs to China. We saw that play out yesterday, and that's something that we need to sort of look at. But as I said, I don't think the FPIs have entirely gone away from the Indian market either. Reema.
Well, yesterday we had a buy figure from both the DIIs and the FIs. So that number will come up for you. The DIIs bought 316 crore in the cash market. The FIs net bought 931 crore in the cash market. So those are the numbers for yesterday. But here's what you need to know. So as Surbhi pointed out, Wall Street took a breather. The S&P 500 eked out a very minor gain of about 0.1%. But it's been a strong week for US equities across the board. The S&P 500 is up 4.1% for the week. The Dow has gained nearly 2% and the Nasdaq has surged 6.8%. And it's the tech giants leading the way. Nvidia, Tesla up 16% this week. Meta, 11.5%. Amazon, Alphabet, both soaring close to about 8%. And Nvidia, by the way, has now turned positive for 2025. And since 9th of April, which was the peak tariff uncertainty day, the Nasdaq is now up 25%. That's the extent of the gains that we've seen. Okay, getting back to the cues back home, fairly inline numbers coming in from Eicher Motors. So that's a positive. Jubilant Foodworks, Tata Power, Muthoot Finance, all perhaps in line to positive. So that's good. On the way down, Apollo Tyres earnings were a miss. So that could weigh on the stock. We'll discuss that in greater detail. As I said, both the FIs and DIIs were buyers in the cash market. The net buy from the two of them together was close to about 1250 crore rupees. Today is the Nifty 50 weekly contracts expiry, so that could add to its volatility. And in terms of earnings, it's mid-cap action. CESC, Crompton Consumer, JSW Energy, LIC Housing Finance, NCC, Page Industries, Patanjali Foods, PB Fintech, Tube Investments, just to name a few. These would be the stocks which should be on your earnings calendar for the day. But Nigel, what are you looking at?
Well, in yesterday's trading session, you had an element of short covering that did play out yet again. So if you look at the Nifty, well, we ended higher and the open interest was lower. For the Nifty Bank, well, it managed to defend a crucial level, which was the 20 DMA in yesterday's trading session, and we popped up from there. So that as well was encouraging to see a bit of a fight back that we saw in the last 60 minutes or so. A couple of big positives that I've noticed in the last few sessions. One is that the mutual fund industry is sitting on a good amount of cash. So in case things get a little bit iffy, we are sitting on a good amount of ammunition here. It's roughly around 6% or thereabouts, which is a positive. The other one is the way the VIX have cooled up. From around the 22-odd mark, we're down to around the 17-odd mark, which is good. And in fact, even yesterday's trading session, the India VIX was down close to around 4% or thereabouts. Cooling VIX is normally a bullish sign. What about positioning? The FIs, they're net short. The clients are net long. This combination isn't so bad as history suggests. In the recent past, we've seen when the FIs are aggressively net short and the clients are long, normally the clients get it correct. So this combination is good. Since today's the weekly expiry, I pulled out two strikes that were fairly active in yesterday's trading session. One is the 24,700 call. It was fairly active in trade. The premium out here is around 66 rupees. And on the downside, the 24,500 put, well, that as well fairly active. Around 50 rupees is what the premium is. You just look at this particular level, that's a 24,700. You add that 67 rupees or thereabouts, and that perfectly tallies in with the high that we saw. So this becomes a crucial resistance mark. That's yesterday's high that we saw. Going by the options data, going by yesterday's high as well, this needs to get taken off to see a bit of a bounce from here on. The support you have at around 24,450. Going by the options data, 50 rupee premium, 24,500 put was seeing some kind of writing. But otherwise, the broader support comes in at around this 23,380 odd level. The question I'm asking is, since the Nifty is only 6% away from its 52-week high, can we see a broader market outperformance? Because remember, those indices, they got clobbered on the way down. And now they need to fight back. So the small cap index is still 13% away. We've seen the last few days the broader market has outperformed. Even the Nifty Next 50, that's 16% away. So I'll be tracking whether or not these indices actually can outperform the Nifty in the near future, just going by the data points that we have. The stock that I'm looking at, since the market seemed to be in a better place, and we've seen exchanges as well like BSE, MCX, etc. do quite well, I'm looking at a stock market play. Angel One is the stock that I'm looking at. Yesterday, the delivery-based buying was there. Close to 2.7 lakh shares were delivered on the NSE itself. That's much higher than the 10-day average. And if you pull up a chart, the 20 and the 50 DMA as well have got conquered. Remember, the stock is a far cry away from the highs that we saw in excess of around 3,000 rupees. But if the markets are in a better place, participation is coming back. I'll keep an eye out on Angel One.
Okay, all right. So lots of individual stocks in focus as well. Nigel, thanks for that. Let's get started by first talking about the global setup once again. Mark Franklin, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, is with us now. Mark, good morning. Thanks very much for joining us on the show today. So, I just want to understand what kind of shifts, if at all, you have planned or you have executed in the strategy in your portfolios since this big event happened, this window of conversation between China and the US, the lowering of tariffs, and at least this 90-day pause that we've got. I mean, we've seen that play out in markets, right? We've seen some tactical money shift to China. We've seen the cool off in gold. We've seen, in general, commodities start to move higher. But as an asset manager, what are the changes, if any, that you are looking at now?
Good morning. Well, if you look at the V-shaped experience that equity markets have given us over the last few weeks, it's created a number of opportunities. The first opportunity is to increasingly diversify our global equities exposure. So to lean a bit more on those regions ex the US. So you mentioned Asia, to some extent Europe and Japan as well. So we're looking for more of a breadth of participation, which founds itself on the idea that valuations increasingly will matter, risk premium will matter, particularly if markets pursue a more volatile, choppier experience over the rest of the year. The second thing that we've done in more recent times is the acknowledgement as a result of the thaw in the trade dynamics, the relation between the US and China in particular. It sort of takes the worst case scenario for the macro outlook off the table for the time being, not permanently so. And what that means in practice is that the market's focus will shift increasingly on the next policy initiative of the Trump administration, which will be tax cuts, spending plans, which are generally expected to be somewhat reflationary. The consequence of that is that we're starting to lighten up a little bit on our bond exposure, particularly US Treasuries, because the economic risks are being somewhat priced out again. And the focus will be more on a reflationary policy mix in terms of the potential. And so not just the curve steepening, but the whole of the yield curve starting to move higher as a more benign growth outlook becomes the base case again. Of course, we do recognize that narratives can subsequently shift again, but that's what we've been doing in most recent times, is just lightening up a little bit on those more defensive exposures.
Mark, hi, morning. Let's talk about India. The many factors which were supportive of India over the last few months, whether it's lower dollar, lower crude prices, trade headwinds on China, they've all reversed. So while India in a way is still relatively insulated from the disruptions that we're seeing, has the sheen come off the Indian equity markets, to your mind?
We also have to bring into the equation the geopolitical dynamics as well. Thankfully, it looks like things are paused there, cooling down. That was perhaps something which represented a bit of a tangential risk to investor appetite for Indian equities. So with that put to one side for the time being, I think that foreign investors are taking a fresh look at India again, not just for the construct of the economy and markets being somewhat more domestically oriented, but the recognition that positioning, particularly amongst foreign investors, is somewhat lighter now than it was 6 months ago. And therefore, there's the potential for a re-engagement and for overseas flows to come back into the market. So we are somewhat more constructive on Indian equities at this point in time, but we do recognize that we have to be somewhat price sensitive, given that valuation multiples never really got that discounted, both relative to history, but also relative to other markets as well.
Hi, Mark. Good morning and good to see you, Ben. You had pointed out that the Indian markets are not particularly cheap. So I think this time correction, price correction, I think that will, hold well. But in terms of global markets, where is your preference right now? The US markets, there were a good amount of longs that were added in the initial part of the calendar year, which got unbound. So give and take everything, what's your top global equity market that you're looking at?
We take a barbell approach at the moment. As I mentioned earlier, a more diversified global equities portfolio than we would have run maybe 6 months ago. And so on one side of that barbell is looking for markets which are somewhat discounted relative to fundamentals and also give you a nice total return potential, not just from capital returns, but also from income. And a market that does fall into that category is the UK large caps, very discounted market, a good dividend profile, and not a reflection of the domestic UK economy, which we know has somewhat of a challenged picture. So that's an example of discounted valuations that we like. We also think that Asian equities also fall into that category as well. And then on the other side of the equation is still looking for those businesses which give you franchise value, thematic growth potential. In that context, we like cybersecurity. We also like defense technology as well. So these are sectors that are not inexpensive. They're somewhat premium valuations, but we can see with a degree of confidence that over the next several years, there's going to be a nice compound growth potential. And so the market will eventually reward that because of the delivery of earnings growth. So combination of earnings growth, thematic strength, alongside those discounted parts of global equity markets, which gives us a nice blend.
All right, Mark, we'll then leave it on that note. Thank you very much. Appreciate the perspective that you've given us today. Thank you very much for joining in. Well, that's one view coming in, and let's get you another one. India right now is the most exciting place to be in. These are words coming in from emerging market veteran Mark Mobius. Listen in to his views. This was an interview that he was in. It was done by CNBC yesterday. He speaks on a whole range of issues, including China, the trade deal and what that means, how India is placed in all this, and even whether gold should find a place in your portfolio.
China is not the only game in town. We're now seeing all these other countries entering the export market and being able to compete. So it's really very exciting to see what's happening around the world. And probably the most exciting place now is India, because India is going to be taking the place of China in many, many areas. And we've already seen companies like Apple and others come to India to manufacture and export. So India, Vietnam, Taiwan, Turkey, those are the ones that are looking very interesting for us at this stage. But as you pointed out, there are many other markets around the world that are doing better than the US. The big problem with India is bureaucracy. As you know, they inherited this incredible bureaucracy from the British, and the party that took over, the Congress Party took over, perpetuated that bureaucracy. But Modi, the new prime minister, has done a tremendous job in cutting through a lot of the bureaucracy, but still there's a lot to be done. And he's digitizing the entire economy. First of all, by getting digitized identity cards for everybody, so money can be transferred directly to bank accounts, even to the poorest people in the country. But this takes time. I call it the United States of India, because you have all these states, many of them with different languages, both written and spoken languages. So to unify this country is quite a job, but still the opportunities are there because you have a lot of very smart people. And as you say, it's the most populous country in the world now. We figure about 1.2 billion people compared to, I would say, now India's bigger than China. China maybe 800 to 900 million. Well, gold is a favorite of mine. I believe everybody should have some gold, maybe 10% of the portfolio, regardless of where the price is at any point in time. It's good to dollar cost average into gold. As regards to crypto, it looks like the U.S. is bound to become a leader in crypto, and that is going to be very important going forward. I personally am not a big fan of crypto, but members of my team are convincing me that we've got to do more in crypto. So we're looking at it more carefully. I'm particularly interested in the crypto exchanges rather than the...
Okay, interesting conversation there. Let's also tell you what the interactions we've lined up for you on our show today. So coming up first at 8:35, we've got the management of Tilak Nagar Industries joining in to discuss their Q4 earnings. 9 a.m., we'll have the management of Berger Paints India to decode Q4 earnings. 9:20, Tahir Badshah of Invesco Mutual Fund will be our market master for the day. 9:30, the management of Tata Power will be with us. And following that, N. Venu of Hitachi Energy India will be chatting with us at 9:40 to talk about the way forward. At 10 o'clock, the management of Shree Cement will join in. And towards the end of the show, in our special segment, Indianomics, Lata speaks to Neeraj Seth of 3R Investment Management on Asian currency and the credit markets.
Time to slip into a short break. We got a lot of stock-specific action to track for you, though. We get to that in just a bit in our special Top 10 segment. But the stocks we're tracking, Eicher Motors, Lupin, Tata Power, Muthoot Finance, Jubilant FoodWorks, Hitachi Energy and Piramal Pharma. All of them will be reacting to positive news flow. On the flip side, Torrent Power, Apollo Tyres as well as Vent India, well, they'll be tracking negative news flow. Slip into that break, come back, get into further detail on all of these names.
Welcome back. Yesterday was a range-bound session for our markets. The Nifty moved around in a 150-point band and finally ending marginally higher at 24,667. But what are the cues? What are the stocks you need to watch this Thursday morning? CNBC-TV18's list of top stocks for the day is coming up, and our team is joining in. And the big one will be Eicher Motors. Sudarshan, numbers largely in line?
That's correct. So I'm going with green for Eicher Motors mainly because of three reasons. First, company's focus on growth over margin has been playing well. Second, heightened competition situation is behind and the company is the biggest beneficiary. And third, in this premiumization trend, company would benefit the most. Now, but the question is, can the stock see the profit booking? The answer would be yes. And it's on the back of first, margin has been below expectations for third straight quarter and valuation remains rich. Now coming to the headline numbers, profit was up 27%, revenue has increased 23%, both higher than expectations. EBITDA has slipped 11% and margin was down 250 basis points and both were below expectations. But market share in more than 250cc segment where company is the leader has gained 100 basis points year-on-year, 100 basis points sequentially and 40 basis points year-on-year. Now about the outlook, company is saying it will continue to see healthy growth and outperform the industry, and one positive part is in the urban area, company is saying the positive sentiment is returning.
Okay, all right. Good commentary as well. Thanks a lot, Sud, for joining in and giving us that update. But let's hop across to Ekta. She's here to tell us about Lupin. Ekta?
Thanks for that. Well, yes, Lupin came out with its numbers late last night and revenue, and it looked good. The revenue was up around 12% odd. The street was anticipating around a 12% growth. Margins came in at around 22%. Street was anticipating 21.8%. And overall, the profit was higher than estimates as well. So that came in at around 794 odd crores. Now, in terms of the key geographies which the street was looking at, the US business came in at around $245 million. This is compared to $209 million year-on-year and versus $235 million last quarter. So higher year-on-year as well as sequentially. So positive news coming in on the US business. India was up around 7% odd year-on-year and growth markets were up around 30% odd. So overall, good set of numbers coming in from Lupin. But what is the US trajectory going forward is something that the street is going to look out for in terms of commentary.
Okay, all right, got that. Ekta, thanks very much. So Lupin is going to be on our radar. More numbers, Tata Power and Torrent Power. Vivek, good morning. How do they look?
Well, good morning. Tata Power, well, operationally good set of numbers, a 25% year-on-year growth as far as the profitability is concerned is something that the street clearly will like. Well, as far as the profitability mix is concerned, what's clearly changing as far as Tata Power is concerned is that the share of the coal JVs in the profitability is reducing. What's increasing is the share of the renewable energy as well as the share of TP Solar, which is the solar cell and module facility. That's clearly ramping up, almost 90% capacity utilization. Well, talking about the numbers themselves, revenue is higher by 8% on a year-on-year basis, EBITDA higher by 39%, EBITDA margins quite strong this time around 19% versus 14.7%, and profitability, like we mentioned, higher by 25%. Now, the solar EPC book remained very steady at a little over 11,380 crore. What is it that the street, will be a little disappointed about? Well, the company had set aside a capex of close to 20,000 crore for FY25. They've achieved around 16,200 crore, indicating that there has been a delay as far as capacity addition is concerned in the renewable space. They had a target of 1.4 gigawatt, have achieved close to 1 gigawatt. This is in line with industry trends where there have been issues, and this is something that we will quiz the management further. FY26 capex guidance quite strong at 26,000 crore. Expect green as far as Tata Power is concerned today. Torrent Power, on the other hand, against consensus estimates, is a clean miss. It's been a muted side, and the profitability mainly boosted by a one-off. There has been a reversal of deferred tax liability of close to 637 crore. Looking at the numbers themselves on a year-on-year basis, largely flat, down 1%. EBITDA up 2% on a year-on-year basis. EBITDA margins up 50 basis points. Profitability, well, aided by one-offs, quite higher. What aided the performance this time around? Gas plants did very well. However, the renewable energy led by lower offtake is something that did do quite well. So Torrent Power expects some red, Tata Power some green.
Thank you very much for that. In fact, we've got the management of Tata Power joining us at 9:30 a.m. for the Q4 earnings. But moving on now to Muthoot Finance. Big jump seen in the company's profitability, perhaps on the back of the rise in gold prices. Vamakshi is here to give us the Q4 lowdown.
Well, a good set coming in from Muthoot Finance. NII stood at 3,355 crores. This is an uptick of almost 6% sequentially and 32.5% on a year-on-year basis. The NIMs too for the company have improved to 7.3% as compared to 7% sequentially. The AUM is also growing at a very healthy pace, up almost 11%, much faster than the growth that we saw in the third quarter. Impairments at 413.5 crores is down almost 3% quarter on quarter. The stage 3 assets to loans also, were lower at 3.4% as compared to 4.2% on a quarter-on-quarter basis. As far as the outlook for FY26 is concerned, the company appears to be quite positive. They maintain their growth guidance at 15%, and in fact, they believe that guidance could see some upward revision after the first quarter. They will be opening 115 branches under Muthoot Finance, and Muthoot Money will leverage 1,000 branches for gold loans. The key risk out here is the fact that any changes in LTV rules by RBI for NBFCs could be a negative factor. But overall, when you look at the numbers that have come in from Muthoot, it's a good set going with the green for this counter.
All right, thanks for that, Vamakshi. Well, in fact, we'll have the management of Muthoot Finance joining us later on the show to detail their Q4 numbers. But Mangalam's up next. And Mangalam, going by the stock you're tracking today, you know what I'm expecting later in the day? A pizza.
Well, it is a pizza party. I'm not the one who will be treating, but I'm sure there will be a couple of team members here who would volunteer, raise their hands and say that they're treating us to a lot of pizzas. But be that as it may, Jubilant Foodworks, what numbers? 34% revenue growth on a consolidated basis, standalone revenue growth 19%. We knew that from their fourth quarter update. So what is it that the street was estimating? They were estimating for the EBITDA, margins and net profit. On all three counts, the company went ahead and beat street expectations. The street was working with an EBITDA number of 277 crores. The company went ahead and did 305 crores. And as a result of which, there was a beat on the margins and the profitability as well. How is it that the company managed to, beat street expectations on margins despite the gross margins dipping by over 200 basis points? Because they curtailed other expenses and employee expenses as well. So there was some rationalization that took place out there along with operating leverage. Domino's like-for-like growth at 12%. Overall ordering activity grew by about 25%. And at the same time, delivery, which accounts for nearly 73% of their sales, out there the growth was 22%. Dine-in was absolutely flat. And that's a positive because earlier few quarters, we had seen a decline in dine-in. So that decline seems to be arrested with strong growth in delivery and overall ordering. That sounds like a pizza party.
Oh, God, we're all hungry already. Remember, we haven't had breakfast. We don't mind early pizzas as well. Mangalam, just say.
Anytime
Thank you very much. Any time of the day. Thank you so much for that. Well, more numbers. Hitachi Energy seems to deliver another steady quarter. Vamakshi, morning. Tell us more.
Well, good morning, Surbhi. It's a good quarter coming in from Hitachi Energy, especially on the operational front. When you look at the revenue, that did miss what the street was expecting. Revenue came in at 1,883 crores. This is an uptick of 11%. But when we look at the operational performance, that has been quite good for Hitachi Energy. And that is because the margins have improved for the second straight quarter to 12.6%. Remember, the company had had given a guidance of double-digit margins. For the full year, the margins are at 9.3%, but nevertheless, for the last 2 quarters, they managed to hold on to that guidance of double-digit margins. Net profit too, seeing a strong uptick of almost 62%, 183 crores, an uptick of almost 62% for the net profit. As far as the order inflow is concerned, that was also quite healthy. In fact, it came in much higher than what the street was penciling in. Order inflow came in at 2,190 crores, an uptick of almost 56%, and the order book too saw a very healthy uptick, came in at 19,245 crores, an uptick of almost 166% as compared to the same quarter previous year. And this is given the fact that there were a lot of HVDC projects that did take that the company did win in FY25 itself. So overall, when you look at the numbers, operationally led beat for Hitachi Energy, going with the green for this counter.
Okay, we've got this management too joining us on the show today, 9:40 a.m. So do tune in to listen in to N. Venu of Hitachi Energy India. But moving on now to Apollo Tyres. Sudarshan is now joining in. Sudarshan, a bit of a miss here?
It's a minor miss to estimates. Unlike Seat and MRF company, Apollo Tyres has missed estimates, and both their major regions, AP, MEA and Europe, have reported muted revenue growth, while EBITDA and margin have declined for both the regions. Now, profit was down 48%, revenue has increased 3%, EBITDA for the company has fallen 19%, and margin has fallen more than 300 basis points, but it was largely in line with estimates. For APMA region, revenue was up 4%, EBIT was down 35%, and margin has come down to 7.2% versus 11.6% in the same quarter last year. And for Europe, revenue was up 1%, EBIT has fallen 43%, and margin has slipped to 5.6% versus 9.8%. But all the focus would be on auto, because remember, internals for the tire industry have improved in last 2 months. So we'll have to see what exactly management says in the analyst call that's scheduled at 3:30 p.m. today.
Got it. Thanks, Sud, for that. Going back to Ekta. Ekta, Piramal Pharma, numbers look good?
Well, yes, revenue was up around 8% this quarter. EBITDA was up around 6% on a year-on-year basis, with margins at 20.4%. Stable year-on-year, but improvement of around 500 basis points sequentially, and a profit of 153 crores versus 101 crores year-on-year. So positive performance coming in from Piramal Pharma. They've crossed $1 billion in terms of revenue with 12% year-on-year growth, and they are on track, according to the company, to meet their FY30 aspiration of $2 billion in terms of revenue, 25% EBITDA margins.
Okay, all right. Ekta, thanks a lot for that. In fact, we'll have the management of Piramal Pharma who will be joining in during midday to detail their numbers. Ms. Piramal will be in touch with Ekta Batra here on CNBC-TV18. Well, there's a big OFS as well that we're tracking. Vamakshi is tracking that one. Vamakshi, tell us more.
Well, good morning, Nigel. When India will be in focus on the back of that OFS, its parent company is likely to sell up to 37.5% stake via OFS, including a green shoe option of nearly 7.5%. The floor price has been set at 6,500 rupees per share, which is coming in at a significant discount, almost 38% discount to the current market price. The offer size is at 487 crores. The OFS will be opening for non-retail investors today and for retail investors tomorrow. But, given the kind of stake sale that is taking place in the company and, the discount that the floor price is at, going with the red for Went India.
Okay, all right, got it. Thanks very much, Vamakshi, for that. So let's quickly recap our list of stocks to watch today. The ones that have positive news flow around them are Eicher Motors, Lupin, Tata Power, Muthoot Finance, Jubilant FoodWorks, Hitachi Energy and Piramal Pharma. The ones that have negative news flow around them include Torrent Power, Apollo Tyres and Went India. Okay, that's our stock list. Let's now find out what commodities have been up to. We have Manisha Gupta joining in with a roundup of all the action. Manisha, morning.
Morning, and thank you so much for that. So it's actually a state of profit taking across commodities in the Asian markets right now. Overnight, we've seen very sharp declines come in for gold, down by almost 2%. And with that, we are trading at a 5-week lows. Not just that we've broken below $3,200 an ounce, but we saw a low of 3,174 as well. Well, the markets are now looking at no more safe haven. The risk is on, and that is what is weighing onto the markets. Not just gold. If you look at silver prices, they fell more than 2%. Copper, after that initial bounce on the US and China trade agreement, a temporary one, also has given into some profit taking. So we've seen 1.5% of decline in copper as well. The metals that are doing well actually are not the conventional ones. So you have tin, lead, nickel. These are the metals which seem to be doing well. But copper, aluminum, zinc, silver, gold, crude, everything trading in the negative in Asia right now.
Okay, all right. Thanks a lot for that, Manisha. For the time being, though, we'll slip into a short break. On the other side, we'll get chatting with the management of Tilaknagar Industries. They'll be joining in to tell us about their past quarter and what's the way ahead.
Welcome back. You're with us on Bazaar Morning Call, and we are going over lots and lots of earnings that have come in post-market hours. Deepan Mehta is with us now. Deepan, good morning. And, for a change, it was nice to see we're coming towards the end of the earnings season. But there are some positive surprises as well. Aisha, for instance, Hitachi, we were just discussing. The margins look really good. And Jubilant Foodworks, pizza seems to be hot again. Let me start with Jubilant, actually, because it's been several quarters of drubbing. And finally, we're starting to see some good numbers. What are your thoughts on the stock, how it's poised? Would you be a buyer?
Yeah, good morning, Surabhi, and thank you for having me on your show. Yeah, I think a good set of numbers. Like-for-like sales growth also, I think, is in the mid-teens, which is very positive. After a long time, they seem to have rationalized their operations and margins also have improved. But look at the valuation that is trading at such rich multiples. And now, I would say a significant portion of their earnings is going to come from Turkey and I think Azerbaijan, where they have got... they acquired the franchise of Domino's. So I wouldn't pay a very high P multiple for those businesses, considering that growth may be slightly slower over there. But nonetheless, I think good set of numbers. I don't think making a fresh acquisition or fresh buying is justified. But investors like us who are holding for a long period of time and sitting on profits, I think they can continue to remain invested. I think the stock has some more way to move up.
The stock has run up in the last 1 year. It's up close to about 48%. UBS says the stock run up in a down cycle now makes a case for profit booking. Goldman Sachs is a neutral call. Citi has a buy. CLSA has an underperformed call. So it's a mixed verdict coming in from the brokerages. Many of them have cited high valuations for Jubilant Foodworks, as Dipan is. Dipan, anything else that catches your attention? Any stock which could be in focus in the back of earnings today?
Oh, I think that Eicher Motors came with a very good set of numbers and they've gained market share across the board. Even the commercial vehicle subsidiary of theirs, that also has gained market share. And most importantly, I think over the year, we saw almost a 33% increase in the export market. And if Eicher starts to do much better over there, then clearly I think it opens up new opportunities for growth, considering that competition is heating up in the Indian market. And some amount of saturation also will come through. But nonetheless, I think great set of numbers, reasonable valuations also. I thought even Bharti Airtel came with a very good set of numbers. And now finally, I think the pricing power is coming back to the telecom industry. Consumers are not complaining when they are paying 15-20 rupees per month more for their mobile bills. And these are, at least telecom businesses are great operating leverage businesses. So a lot of it may flow to the bottom line. It's coming to an end of its capex cycle also. So I think in the large cap, these two were exceptionally good set of numbers.
You know, in the Bharti Airtel conference call, which took place yesterday, the investors also quizzed them that you made a proposal to the government, the DOT, about converting AGR.
I was thinking about that.
Yeah,
just like Vodafone Idea, right?
Just like Vodafone Idea, right? So to which Gopal Vittal said that it's actually just exploratory in nature. We wanted to assess whether we have a level playing field with Vodafone Idea, right? You approved it for Vodafone Idea. Will we also get that approval or the green signal? So he said, as of now, it's exploratory. Let's hear back from the government, and then the board will take the final decision. So it's not that they want to.
Yeah, but why not? If it's available, why not?
Not even why not, right? Like, is there a level playing field? I think that's what they wanted to assess between the various players. But let's talk about Tilaknagar Industries. That's the first corporate on our show. Now, their Q4 revenue growth was healthy. It was led by a 20% volume growth as the Andhra Pradesh issues got sorted. Margins also expanded, aided by a subsidy. If you strip that out, margins would have come in a little more than 16% in line with the company's guidance. Amit Dhanukar, CMD at Tilaknagar Industries, is now with us on the show. Amit, thank you very much for joining in. Q4 volume growth of 20%. Could you break that up? How much of it was in Andhra Pradesh? How much ex of Andhra Pradesh? And in FY26, what is the volume growth that you're looking at? Historically, you've done about 13-14% kind.
Right. So I think we ended the quarter quite strong. I think I've been giving the guidance earlier on the show so that, the revenue growth will be back. The Andhra Pradesh government, as all of you all know, it went through a transition when the government changed in June of last year, and then the current government, they decided to change the policy in terms of privatizing the retail, which took place in October of last year. So there was a transition, which is why quarter 2 and quarter 3 was slightly subdued for us in terms of growth, but I think that's behind us. And we have bounced back quite strongly in quarter 4 with the overall volume growth of 20%. Of course, the growth in Andhra Pradesh would be in excess of that. I think that's looking more like 30-35%. And, with the strong momentum build up in quarter 4, we're carrying this forward into quarter 1 and this fiscal year as well. So we're very optimistic about the volume growth for this year.
Okay. All right. Hi, Amit. Good morning.
Good morning.
Thursday morning, and we have to talk about spirits because of the nature of your business. A little early in the week, but let's get a couple of numbers out of you. Last year, you did around 11.9 million cases. For this year, what kind of a volume growth can you deliver since you're saying that things have bounced back and normalcy has returned? Are we bracing for mid-teens volume growth? And what would it mean in terms of revenues? Last year, you did roughly around 1,430 crores.
Right. So as I mentioned earlier, Nigel, I think the volume growth for this year will largely mirror, the quarter 4 volume growth. I think we expect clearly high teens volume growth for this entire year, and our revenue growth should roughly, track the same percentage.
So last year the revenue grew. Amit, hi, morning. Last year the revenue growth was in low single digits. I'm talking about top line, right? It's just about 3%. So are you saying it's going to be in the same vicinity? Why is that?
No, it will be in the same vicinity as the volume growth for this year. So the volume growth we are projecting in high teens, and we expect the revenue growth
to be in the same arena. Okay, let's talk margins as well. Let's talk margins and realizations. From what Mangalam tells us, your realizations per case are at 1,214. Which is a little lower than where they were in the same period last year. So what is the visibility on blended overall realizations across the portfolio, and therefore what will be the margin trajectory this year?
Yeah. So I think going forward, the NSR will remain largely in the same range. I think while we do get the benefit of premiumization and selling some premium brands, but we did a price correction on our flagship brand in Andhra Pradesh in November. So, that was done in line with, the competitive movement in that category. So that price correction now will have the full year effect in this year. So, by and large, the NSR will remain same. And the margin outlook also, will be around 15.5 to 17%. That is the outlook which we expect for this financial year.
Would it be closer to the upper end? In Q4, it was about 16.6% adjusted for the subsidy.
Right. So, while we will get operating leverage in this year, on back of, say, high teens volume growth, but, we will be investing quite heavily in ANSP in this financial year. I think they are on two fronts. One is, of course, as, I maintained before, we have been the leaders in the brandy category. And our endeavor now is to increase the share of voice for brandy. So in line with that, there will be increased spends in terms of communication. And also we have few premium launches, which we have already done. We launched Monarch, which was a luxury brandy in September of last year. And we intend to launch a luxury whiskey in the first half of this year. So, the premium brands, the first year, the advertising and marketing is going to be slightly skewed. So, with increased A&SP spends, that will put some downward pressure on the margin as well. But, we're in an investment phase now. Our company is very healthy. I think we're looking at investing behind our distribution, our international footprint, and increased brand footprint. Yeah.
Okay, all right, interesting. That you're looking at launching a premium whiskey as well. And in the last few years, after getting out of that debt trap, suddenly you have started diversifying from being a core brandy company. Currently, the brandy as a mix of a percentage has come down, I think, to around 91%. How do you see this mix evolving?
Right. So, Nigel, the previous year, brandy as a percentage of our portfolio was closer to 95%. So, we've made some progress in this year now where brandy is 91%. And, our vision is that, by 2030, which is, say, 3-4 years from now, brandy will still continue, being the core of our business, but we expect it to be around 80% by 2030.
Okay, so 80% by 2030, that'll be the share of brandy.
Yes.
Amit, I'm just going back to that point of competitive intensity that you mentioned for your flagship product, which is why the overall realizations were impacted. And we'll see the flow through this year, like you're saying. I'm just a little curious. I mean, is that only for one particular product? Is it only in one state like Andhra, or is it across the board? And as a corollary, let me also ask you this. I don't know if you're impacted at all with this UK FTA. Now, I don't know if any of your premium products will see any competition. I'm not sure about the imports. If at all we're getting brandy, or any of your portfolio products could face more competition, especially at the premium end. Just tell us that, and also a little more about this competitive intensity and whether other brands in your portfolio, can you take any price hikes at all, or will we just see pressure?
So I'll take the second question first. With regard to UK FTA, I think, our company, we've had very limited imports. So I don't really see any material impact for us right now immediately, but I think it's a good development for us in the medium long term. As we
does it add to competition? I mean, I don't even know if we import any premium brandy from the UK or not. But do you see more competition because of cheaper imports coming in from the UK?
So that's a difficult question to answer right now. I think we'll just have to wait and see how it plays out, because of course we compete at price points. So of course within brandy well leaders, but we compete with whiskies as well at similar price points, which is one of the reasons we undertook some corrective pricing in Andhra Pradesh last year, because it was more in terms of being available at a particular price point. So I hope that answers your first question.
Amit, the company has also been embroiled in a trademark dispute. I think the news came out in the month of February, where other companies are allowed to use Mansion House, Savoy Club trademarks. And you sought an injunction against that, but I think it was quashed by the Bombay High Court. So what is the latest on this particular dispute? And has there been any loss of revenue or any impact on your business, negative impact on your business on account of this?
Right.
And how will you expect this to proceed?
So there's been no negative impact, because our use of the mark, continues exclusive and uninterrupted, and we have been the exclusive and uninterrupted users of the mark in India since 1983, and that is continuing. So there's no direct impact on the business. As far as the legal proceedings go, the matter is sub judice, and currently the counterparty, the body corporate against whom we had sought an injunction, they have given an undertaking as to they will not act on the February 7th order till the next date of the hearing. So currently it's status quo.
Okay, all right. And just to clear the air with regard to the M&A opportunity, from being heavily net debt, you've moved into the green, must be feeling good about it. But the last time around, I was quizzing you about Imperial Blue or other such brands. Anything on the horizon?
So you're right. Now, we're cash positive, and the outlook also is looking good for this year. So we'll always be alive. I think our strategy would be focused on organic thrust as well. And the outlook for organic growth also is looking good for this year. But we'll always remain, alive to inorganic opportunities if they fit in line with our strategic vision for the next 3, 5, 10 years.
And Imperial Blue?
So I can't comment on specific opportunities, Nigel. That's a difficult one. But we always evaluate. I think whatever comes our way, we keenly take a look at opportunities.
Okay, all right. Thanks a lot, Amit, for joining in. That Samsara Gin, it's a very small part of your business, but that's a good one. Brandy is not something that I taste, but I think that Samsara Gin is good.
You've been a big fan of Samsara, Nigel.
Yeah, I mean, for the last few times. But y'all have still a small stake out there. So from the stock market perspective.
We have a small stake, but we do have a pathway towards increasing our stake. And that business also, though it's been small, as you pointed out, but it's high on the revenue and it's grown well for FY25 as well.
Amit, now I have to ask you this since you mentioned. Are you going to, because as a brand, it's extremely popular. We all can tell you that. Are you going to be looking at increasing your stake in Samsara? How much money can you put to work? How much can you go to? And will it at some point start contributing to the consolidated numbers?
So at some point, we do expect it to start contributing towards consolidated numbers. And we do have a pathway towards increasing our stake. And we are looking at that actively.
Okay.
Maybe that's a part of the 2030 goal where the contribution of non-brandy comes down to, increases to 20%.
Too much of alcohol in the morning. Amit, thanks a lot for joining in. We had more time. I asked you how the tequila market is shaping up with the gin market, but that's for another day.
Now we go back to
Thanks a lot, Amit, for joining in. Well, let's get in Deepan Mehta back on the show. Deepan, you heard the conversation we had with Tilak Nagar. This is a company that was absolutely, bombed out, big debt in their books, but they made their way back. Any view on the stock, or what do you prefer from from the beverages space?
See, Nigel, I think investors looking for new FMCG plays, I think domestic alcobev companies can really fit that criteria. Whether it's Tilak Nagar, Radico Khaitan, Som Distilleries, Allied Blenders, I think all of them have done exceptionally well. I think they're managing the state regulatory environment far better than the likes of United Spirits and United Breweries, and they're all quite reasonable except for Radico. I do like the business of Tilak Nagar Industries and massive market share in the brandy market, second largest brandy in the world and largest in India. But this entire cloud about this trademark issue, that really kind of puts a big scare, because should something go wrong over there, it will completely disrupt the operations of the company. They do not have any secondary brands as well. So on the whole, we like the industry, but Tilak Nagar, I'm not so sure because of this particular legal case. Although I do feel that Allied Blenders and even Radico Khaitan from distilleries, I think they have great prospects going ahead.
Okay, all right, got that. So not particularly Tilak Nagar, but other companies, a couple of companies like Allied Blenders could look up. Got up. Deepan, I want to ask you about Eicher Motors. From the frontline pack, that came out with a set of numbers. The commentary was a little bit positive as well out there. How would you view the stock from here on?
Yeah, I think that, we were doing a quick analysis of the nifty companies which had high teens growth in the last 10 years. And there were just 4 or 5 of them, and Eicher Motors was one of them. It went through a lull, I think, 3-4 years ago and then started picking up, I think, from this year onwards. I'm particularly impressed with the progress made on the export markets, because if they do well over there, it opens up new opportunities. Reasonably priced share, I think. And certainly, even at these levels, despite there being some slowdown in the auto industry and two-wheeler industry, I prefer Eicher Motors. It's a great rural play also. So if monsoons do well, this company also should do much better. Having said that, it's a company in which we and our clients are invested in.
Just a reminder to our viewers, yesterday in the second half of the session, the entire railway pack suddenly got turbocharged, and that included all kinds of stocks from an IRFC to RVNL to, the entire likes, even some of the private sector names. Deepan, just your thoughts here. I mean, I'm not sure if that was just a flash in the pan because in general PSUs were up, or whether they're sensing something. But would you be looking at any railway stocks at this point?
Not really. I think they are fairly valued, and it's an old story, pretty much well discounted, well understood. These stocks move up and down based on order flows and performance. But no doubt, I think railways are going to invest more and more in the infrastructure, and that's going to benefit these companies. But I think amongst the entire investment theme, I think IRFC certainly is something which is quite interesting, given its position and given the new opportunities it has got to increase its loan book.
Deepan, hold your thought. We'll slip into a very short break. We'll come back and also get in a few technical trades. Stay tuned.
Welcome back. Hope you're having a good morning. Well, for starters, the gift nifty suggesting a more or less flattish start to trade. Maybe a mild positive bias, 35 points higher. But Sudarshan Sukhani as well as Chandan Taparia are joining us for a quick technical check. Good morning, gentlemen, and good to see you all in as always. Sudarshan, you're maintaining your positive bias. Well, yesterday, in fact, we had a bit of an intraday dip. The markets moved into the red, but recovered swiftly. Would you recommend buying on the dip yet again?
Yeah, good morning. Yes, the trend is up. And see, what happens is after a 1,000-point rally, markets will consolidate. We cannot expect markets to have some kind of a gain day after day after day. That doesn't work out. So we are in a process of consolidation, but the consolidation does not change the overall short-term trend, which is that we are slowly inching higher. So every small dip is a buying opportunity. Now, there are two ways to exit. One is if you see a rally, whatever modest profits are made, get out. If you are a positional trader, if you buy on a dip, hold on to it. Now we also have an exit strategy on the lower side. That is somewhere around 24,400. So if the market, that is the place where the gap up had happened on Monday. So if the Nifty, if were to start sliding below 24,400, then obviously all bets are off and something different is happening. Till then, buy on dips.
Okay, buy on dips is the call. Sudarshan got that. We also have Chandan Taparia with us. Chandan, good morning. What about you? Mid-cap market is in party mode, but the large-cap index is consolidating. What is your approach today?
Yeah, good morning. Thanks for having me. So really, the Nifty managed to recover well from lower levels in last 3-4 days. However, it has been consolidating from last 2 days, witnessed some profit booking as it fell to surpass 25,000 marks. But the good part is that advanced decline ratio is better and many mid-cap and small-cap stocks are doing well. In fact, many small price name from FNO and non-FNO counters are witnessing sustained buying interest, including selective railway, defense, metal, auto ancillaries. So I believe that we need to focus more on the stock specific until Nifty holds above 24,444. Overall buy on decline could continue for an upside move towards 25,000. So I believe the VIX has to cool down below 14-15 marks and Nifty needs to hold about 24,444 to continue the positive to range bound, while stock specific action could continue to buzz well in this market.
Okay, got that. Let's come to stocks as well. Sudarshan, morning. What's your stock list looking like? What are you trading today?
Yeah, good morning. Well, you talked about mid caps, and it's all mid caps and small caps, except for one. Exide Industries is a buy, the stop under 357. LIC Housing Finance and finance and banking are going to be outperforming sectors, I think. LIC Housing Finance is a buy, the stop under 604. The large cap stock is Bajaj Auto, which is a buying opportunity with a stop under 79.50. And finally, again, Ramco Cement is a buying opportunity, stop under 975. It's a good idea to focus on stocks and let the index be.
Okay, all right. Got that. Chandan, what about you?
Yeah, so first is buy on BL. We have positive on most of the defense name, be it BL, HL, in fact, counter like Mazgaon Dock, Cochin Shipyard, GRSC, Paras. So positive on the entire defense theme and expecting 5 to 10% rally in most of the counter. But here, as a top pick, I'll go with BL. The stock has been making higher tops, higher bottom from last 4 days. It has given a breakout on the daily and the weekly chart. In fact, on the monthly chart, it has given a breakout from its bullish pole and flag pattern, which has potential target of 15-20% on upside. But on immediate point of view, suggesting to buy on BL with support of 337, and this stock can head towards 360 marks. Second trading area, that is buy on Union Bank. Selective PSU banks and small private banks started to witness buying interest. Union Bank has seen the decent run-up in last 4 days from 115 to 135. It has given a consolidation breakout of last 40 weeks and delivery volume as well as the open interest activity is rising in most of the counter. So expecting further up move, one can buy with support of 131 for target towards 143. Third idea, that is buy on NMDC, positive on the metal mining name. And most of these counters have bottomed out and a small follow-up can lead to the short covering trigger. NMDC has managed to close near 70 and a small follow-up can lead the counter towards 75, 76. So one can buy with a stop loss of 68 marks in NMDC.
Thank you very much for that, gentlemen. We'll slip into a very short break. When we return, we'll get you the pre-opening rates. We'll also get chatting with the management of Berger Paints to discuss their Q4 numbers. And remember, this is a company which has outperformed its peers. Berger's volume growth in Q4 was 7.4% ahead of Asian Paints' 1.8% growth. More details coming up with Abhijit Roy.
Back to that conversation with Deepan Mehta. Deepan, hi, morning. So we discussed railways earlier, and you made that point that this could probably just a sentiment-based move. But now let me ask you about defense, because this defense rally is something that you can't ignore. The index is already up 8% in the last 3 trading sessions. And we know that the orders are coming in. That's not the problem. And the narrative, the theme, all of that is fine. The question is figuring out where the P&L looks the best and the valuations aren't too high. So do any stocks meet that criteria for you?
What are you saying? 8% in the last 3 months. It has gone up by 45%. The India Nifty, India Defense Index, if I get it right. And look, I think these stocks are in focus because of what has happened at the border, and a lot of investors also looking to increase their exposure there. But it's a small portion of the overall market capitalization, about 2% or so. And all of the stocks over there are really, really expensive. This is not a business that you can quickly scale up and keep on doubling your profits every year or so. So investors need to temper their optimism. It's a great sector to buy when the chips are down and when there's a correction, when it is not in the limelight, as it does happen from time to time. But buying these stocks at these levels, I'm not sure the risk-return profile will favor you. The PEs are so expensive in the range from minimum 40 to 100 times or so. And buying businesses at those PE multiples, 2-3 years down the line, you realize that the profits have come through, but the stock price has not made any great gains. So I would avoid all defense stocks at this point of time. It's a contrarian view, but I think it's a conservative view.
Okay, all right. Deepan, I was so happy to hear after a couple of years that you were interested in cement. Yeah. And that call's actually playing out well, because otherwise we don't have too much in common besides understanding the market. Because metals, so you don't like, but luckily for me, cement is something that you found some interest. And actually the last couple of numbers have started looking up. I recall on Editors Roundtable as well, I put out this piece that maybe cement could be the pocket that will start surprising, because not affected by Trump or any kind of global activity. What's your view on the pack? Shree Cement came out with a set of numbers. It's a good set of numbers. The problem for Shree is valuations. But your take, and what's your top pick?
See, Nigel, it's not just cement that we now have commonality, but for many, many years, we have been very positive on Aisha, you for its motorbikes and me for
I came on it.
But nonetheless, I think cement prospects are looking up. It's a cyclical industry. And certainly, I think the upcycle has started for the cement industry. Execution across the board will improve, whether it's for infrastructure projects, whether it's for real estate projects. And that, I think, will improve the demand. Also, they're getting some benefits on the cost side as well. And overall, I think that the industry is getting a little bit of price discipline in place as well. Top picks have to be ACC, Ambuja, I think, best-in-class performance. And there's an opportunity here, at least in ACC, to improve the efficiency, which can flow to the bottom line. So I would prefer those companies rather than the super efficient players like an Ultratech, or for that matter, Shree Cement.
Okay, got that. By the way, the pre-open is telling us it's going to be a slightly quiet start, which is all right. I mean, sometimes it's okay to open quiet and then build on it. 16, 17 points higher on the index. But I was looking at the result reactions, and the early indications are that Tilaknagar Industries will definitely start the day on a high. About 8% up on that stock. And you just heard the management there talking about their prospects, sounding quite optimistic. Muthoot Finance is the other one, 5.5%. And this is the management we'll speak to shortly. The others, Kalpatru project just announced a big order win. It's been flashing on the ticker as well. It's a pretty sizable order, over 2,000 crores. So watch out for this stock. E-Clerks, Lupin, these are some of the other positive result reactions that are coming in. But Karnataka Bank has been a disappointment. So from the earnings front, I think that could be slightly on the back foot. 4% down in the pre-open on Karnataka Bank. There we go. But since we're talking earnings, let's quickly rewind. Eicher Motors. It's been a good quarter. And as Nigel's been telling us, all the Royal Enfield fans perhaps will be happy because Eicher seems to have delivered. So Darshan, do recap the numbers, the commentary, all of that for us, please.
So Eicher Motors' performance has been playing as per company's playbook because company has been saying that it will continue to focus growth over margin. So even in Q4, we saw that both profit and revenue have seen healthy growth while margin has slipped. Also, it has come slightly below our expectations. Profit was up almost 27%. Revenue has increased 23%. EBITDA has slipped 11% and margin was down 250 basis points if you compare year on year. Also, realization was flat. It was up 1% sequentially and down 1% year on year. But what is good part for Eicher Motors is the market share gain that it has been seeing in the segment of more than 250cc. In there, it has gained market share of 100 basis points sequentially and 40 basis points year on year. Talking about the outlook, company saying that it will continue to see healthy growth even in FY26 and will outperform the industry. And one good thing that company has talked about is the positive sentiment is returning in urban, and that was reflected in the month of April numbers.
Okay, all right. Thanks a lot for that, Sir. Let's hop across to Vivek. He's here to tell us about Tata Power. Vivek?
Well, good morning. Well, Tata Power, when you're comparing it against the estimates, it's been an operational beat. Now 25% year-on-year growth as far as, the profitability is concerned. And that is something that the street will like. Let's have a look at the internals and the profitability mix. Number one, what has contributed to the profit? Our contribution to the profit mainly from the renewable energy part of the business and the solar EPC business that have clearly delivered. Coal prices have been down, so the share of coal JV in profit has been lower. And along with that, one thing that the street will look forward to is the capex. So the FY25 capex, the company at the start of the year had given a guidance of close to 20,000 crore, indicating almost a 1.4 gigawatt capacity addition as far as renewable energy is concerned. What has the company achieved? Close to 16,200 crore, indicating that there has been a miss as far as capacity of renewable energy is concerned. However, the company said that it should be done within the first couple of quarters of FY26 itself. FY26 capex guidance very strong at 26,000 crore. We will have the management joining us shortly. Couple of important questions. Number one, what led to the delay as far as capex is concerned? Number two, the UP Discom privatization, and that will be something on top of most of the analyst minds. What is the status of that? And Mundra continues to operate under section level, thereby not impacting profitability, but any visibility as far as long-term PP is concerned. Yesterday, the management did allude to the fact that talks are at advanced stages over there. So that'll be something that the street will look forward to.
Thank you very much for that. The big stock on the way down is Wendt, and that's where the promoters are looking to sell some stake via an offer for sale, and the stock is locked in a lower circuit. Wendt, is that the correct way I'm pronouncing it? I think, yeah, that's the one you should watch on the way down. But let's talk about Muthoot Finance. Ramakshi is here to recap the numbers.
Well, Rima, it's a strong set coming in from the company, and I stood at 3,355 crores. This is an uptick of almost 6% sequentially and 32.5% on a year-on-year basis. The NIMs too have improved from 7% to 7.3%. The AUM growth has also come in very strong, up almost 11% sequentially, much faster as compared to the 8% growth that we saw in the third quarter. Good growth is also being accompanied by good asset quality as well. Impairments were down nearly 3%, and stage 3 asset loan came in at almost 3.4%, much better than 4.2% seen in the previous quarter. FY26 outlook from the company also looks quite promising. Guidance on the growth is maintained at 15%. And in fact, they've also said that the guidance could see some upward revision in the first quarter. They will be opening 115 branches under Muthoot Finance, and Muthoot Money is also expected to leverage 1,000 branches for gold loans. So overall, when you look at the numbers that came in from Muthoot, strong set.
Thank you very much for that. Sudarshan is back with us for his 9:10 call. Sudarshan? Sudarshan?
Stop under. Hello.
Yeah, go ahead.
Okay, buy Exide Industries with a stop under 357.
Thank you very much for that. Now let's invite the management of Berger Paints. They've reported a good set of numbers. The company's volume growth came in at 7.4%. Ahead of competition, Asian Paints had a volume growth of less than 2%. And the company's margins too have expanded to 15.8% versus 13.9% in the prior quarter. We have with us Abhijit Roy, MD and CEO at Berger Paints India, to talk about the way forward. Thank you very much for joining in. Before, we have the numbers for the quarter gone by, but looking ahead, if you could help us with your expectation for FY26 in terms of volumes, revenues and margins.
So as far as volume and value is concerned, I think it will be progressively improving as the year progresses, which means, quarter one will be slightly better than quarter four. Quarter two will be even better, and quarter three will be better than quarter one and quarter two. So that's how it will progress. As far as margins are concerned, more or less it will be at similar levels as we are, currently, which is around the 16% to 17% mark. Our guidance has always been between 15 and 17. We have been operating towards the higher end of the guidance, so we will probably remain at that level.
So for the full year, what kind of volume growth will we see as you expect progressively improving numbers?
High single digit to double digit. That's where we should be.
And margins 15 to 17% as you've always been guiding for.
That is right.
Okay, all right. Hi, Mr. Roy. Good morning and good to see you, Ben. Tell us about the competitive intensity. Last year was quite good, actually, because you have a large player that's come in, but you have still managed to go ahead and increase your market share by around 80 basis points. So what kind of a challenge is Birla Opus posing to the industry? And where do you see your market share go from around this 20.3%?
So, it's a big company and, they're spending a lot of money. Much of it, some of it, therefore is, extra than, what we have seen in terms of competitive intensity in the industry. Obviously, that buys some market share, so therefore, there is a temporary turbulence, I would say. How long that is sustainable and the type of strategy that is being followed, it has to be seen, but we have managed to stay afloat. We have our own growth opportunities, though there might be, marginal losses in some of the accounts, but we are reasonably certain that we should be able to maintain our market share at current levels.
Okay, possibility of you increasing it?
Well, it depends, as far as we are concerned, we'll continue to work, rest is up to the competition, how they shape up and what they do. It's not up to our, so market share gain is typically, what you do, different and beyond what is the normal. So we have some of our own strategy, which we think is going to work, has worked last year, will continue to work this year as well. So therefore, depending on how we execute that, how we execute those ideas, it will give us either some gain or, or we will just be able to manage our market share. But we are hoping that we will be able to definitely maintain, and if not improve a little bit.
Some of the economy categories like low-end primers, emulsion are facing the heat and there's lower pricing because of competition. Do you expect that to sustain? What is the outlook on raw materials? And I know you're maintaining margins, but your sense of raw materials in the near term and pricing of your end product?
So yes, the lower end products, as you rightly mentioned, is facing competition because those are price sensitive products. And if you start spending on those categories, you are likely to gain some share. We have been careful in not being over the line, and going overboard in order to defend. We defend to the extent that is necessary. We make up for that, marginal loss in profit from other areas of, selling more premium and luxury products. And more profitable products, therefore. We always look and strive for improvement of profitability through various means, cost initiatives, even product formulations, launching innovative products. We have launched some very innovative products recently. One of them, Roof Cool and Seal. The other is Tank Cool, which keeps the water in the overhead tank cool. In this hot summer, it becomes a big problem to bath in the afternoon. So there is, this system which we have created, which if you coat the tanks with, it will reduce the temperature by almost 8 to 9 degrees. So those are innovative products which are consumer need unmet so far, and which we keep, selling in the marketplace. And there the margins are always higher. So we have our own strategy in place, which we would like to, carry on with.
Interesting innovation out there, Mr. Roy. But before we let you go, give us a split between rural as well as urban. And as of now, are you see things improving on the urban front?
So, we have some strong points in the urban markets, and some very weak areas like Mumbai or Bangalore or Hyderabad for that matter. So what we are doing is, trying to improve our distribution network in the weaker markets and maintain our strength in the stronger markets like, Kolkata, Lucknow, Delhi, etc. So these markets, we will have the maintenance job of maintaining a market share and ensuring that it doesn't get disturbed so much. And in the other areas, we have a fair chance of gaining heavily because our networks itself is, an issue, and which we are tackling through some, of our own distribution strategies. So this is what we are looking at. But as far as rural and demand, urban is concerned, the demand is more or less similar in nature. We haven't seen, actually in paint, we don't have pure rural, unlike FMCG. So they go into, much more villages and, penetrates it very deep. In our case, it's mostly urban, semi-urban, small towns where we, sell our paint because you need pakka houses for that purpose.
Yeah.
But more or less, the demand has been similar in nature. This talk of, urban being, different from rural doesn't hold true as far as, the
for your industry. Got that point, Mr. Roy. Thanks very much. And that's a very innovative solution. As someone who spent the better part of my early years in North India, the water heating up in tanks is a real problem in those urban and semi-urban areas. So quite interesting there. Thank you very much for joining in. That is Berger Paints. We are down to about 5 seconds to the market open. It's going to be a quiet start. Let's see if the bulls can build from there. That's the real question. About 11, 12, 15, 20 points now up on the Nifty. Mid-cap index, like yesterday, is doing better. The gain there is about 0.25%. Banks are absolutely flat. Now there's a little bit of red flashing on the screen. Bank Nifty and the Nifty flip-flopping between negative and positive. Not too much of direct leadership, visible. And banks were a problem for the market yesterday as well. Let's get the heat map up. So it's neither here nor there. You don't have too many, major pulls on the downside, but you don't have too much of leadership also. So therefore, there you see, it's almost a 50-50, even Steven kind of a screen. Net neutral, but the bias is slightly negative for the time being, and the Bank Nifty holds the key. Bank Nifty for the time being is down about 100 points.
Well, from the broader markets, a few stocks actually are calling for your attention. The ones that are doing really well is Tilaknagar Industries. Well, the stock is up close to around 10%. Management sounding extremely optimistic. Volume growth in Q4 was very, very strong. The street likes that. So that one's up close to around 10%. Vascon Engineering, well, the numbers look very, very good. They've gone ahead and for a 1,000 crore market cap company, they've raised close to around 45 crores via selling a stake in one of their, ventures that they had. So that's around 4.5% of the market cap. So that's why that stock is up. Finally, the numbers coming up. Remember, the stock has come off big time from the top. Other couple of stocks that are doing quite well today. You have Lurch Revenues Tech. Well, that stock, in fact, is up close to 4.5%. I think it came out with a good set of numbers. So that's one stock that's moving well. Sri Renuka as well is moving up on decent amount of volume. So good move out there. Piramal Pharma started up gap up with a gain of close to 4%. But that's given up some part of the gain as we speak. The ones that are under pressure, I think Bazaar style retail. The stock is down 7.5%. So some selling being seen out there. Which other stock is coming on the radar? You have ADF Foods that's down close to around 5%. I don't know what's gone on there. And Dam Capital, remember it listed, it had big gains. But from the top, actually, the stock has got slammed. And I think it came out with its set of numbers. The street maybe were expecting more because the stock is down close to around 4.5%. And Karnataka Bank as well, I think we highlighted earlier.
Yeah. Muthoot and Karnataka seem to be the two result disappointments so far this morning.
Well, Eicher Motors has opened in the red. So despite in-line numbers, the stock is down close to about 1%. Numbers were in line, but valuations are expensive for Eicher Motors, and Eicher Motors is spending on growth. So margins are perhaps, according to some analysts, could get impacted as the company is now investing for growth and spending for driving growth. So Eicher Motors in the frontline pack is the one which a big move. IndusInd Bank is down over 1%. On the way up, you've got strength in JSW Steel, Hero MotoCorp. These are the only two stocks with gains of about 1.5%. On the way down, we spoke about Muthoot Finance. The other one is Karnataka Bank. Disappointing set of numbers. The NII has contracted. The stock is under pressure. Sagility is the other one. Again, stock reacting to numbers. On the way up, I think Sharda Cropchem had a positive tick early in trade. Very strong numbers. Revenue growth of close to about 6.9%. 39% revenue growth. Volume growth was about 48% in the agrochemical segment. The herbicide segment was also an outlier with a revenue growth of 57%. So strong numbers. And Apollo Tyres, we thought the numbers were a bit subdued relative to peers, but Apollo Tyres has actually opened up in the green. So that's the other one bucking the trend.
Okay, all right. So quite a few of those result reactions continue to play out. Overall, though, it is a far more cautious morning than what we had yesterday. Yesterday, right from the morning, the mid-caps were doing very well. But today, it's a little more measured at this point in time. So let's see how this plays out. Large cap screen, the losers include an IndusInd Bank, Dr. Reddy's, ONGC, M&M Eternal. So it's really mixed. It's across the board today. Not very clear sectoral trends coming out, at least so far.
Some of these railway stocks like Texmaco Rail, Ircon, I think are still continuing, extending their rally.
From yesterday, yeah. That buzz is still on. And watch for sugar, Renuka and Bajaj Hindustan, both seeing some buying as well. All right, we've got Tahir Badshah joining in. He's our market master of the day. And of course, he is from Invesco Mutual Fund. Tahir, thank you so much for being here with us. So, the market's had its hurrah moment and it's been a fabulous comeback from those early April lows, right? The question really is now what next? Because now we're back to asking about the micros, about things like earnings, till the flows come back in a big way. So when we talk about those core fundamentals, which is earnings and valuations, how are we poised after this strong pullback in April?
I think before, we saw this market once again start to kind of recover significantly over the last 6 odd weeks. I think what we had seen was roughly about a 10% correction in the valuations of large caps and probably close to about 12 odd percent on the mid cap indices, and perhaps more closer to about 18-20% as far as the small cap index was concerned. From there onwards, of course, we've seen a rally, and good part of it is probably covered. So I would assume that still compared to, let's say, December 31st levels, which were where the markets probably peaked, we still probably have some valuation decline. But meanwhile, like as you rightly said, I think the focus after many of the other clouds having cleared over the space of the past few days has shifted to earnings. And on the earnings front, I think what has come out so far seems to be quite nice to see. And probably that should, impart some support both to the strength of the market as well as overall valuations as well. So I think what we've seen up until now, whether it be in the large cap space, mid caps as well, there's been a fairly strong delivery of earnings. We are still halfway through the earnings season, but by and large, in terms of representation, probably about 70 to 80% of the market cap in each of these three buckets is probably now already through, and we are seeing roughly about double-digit kind of growth at an aggregate level. But mid caps have done stunningly well with probably a 18 odd percent growth, if I'm not mistaken. That's what I probably saw at an aggregate level. Small caps have trailed, but partly also on account of commodities and metals. If you strip off that, it is still single digits. Not too great, but nonetheless, I think it takes away a lot of risk as far as expectation on earnings is concerned, and particularly compared to the September and December 24 quarters.
Tahir, hi. Morning. Rima here. Is there a real risk that money moves out of India into China? When you speak to other investors who have that option, is there going to be the tactical switch?
It's quite likely. I think even before probably the last week that we saw climb down as far as US-China trade tensions were concerned, we felt that, at least I was of the opinion that probably this time around, when flows return to emerging markets, there will be a fair bit of China too will be a reasonably decent beneficiary, unlike, let's say, over the last 2-3 years when generally India has dominated the scene. And that's thanks to probably, deep seek at one level, and probably the realization over a period of time that the Chinese economy is trending somewhat differently compared to what it has traditionally been. Traditional sectors have started to kind of look a little more, stable, real estate, infrastructure, their own domestic consumption. And alongside which it is now probably being viewed from the lens of, an economy which is reasonably tech-oriented, whether it be in the form of things like artificial intelligence, automation, robotics, medical automation, etc. So I think the complexion of that economy is changing, and probably global investors would be inclined to look at least some parts of the economy from that lens, which perhaps is a place where India probably does not provide them that opportunity or exposure. So I think it'll be India plus China in terms of flows as we go along, and especially if emerging market flows improve on an aggregate.
Okay, all right, Tahir. Good to see you after a while, Tahir.
Thank you very much.
How would you position yourself, though? Because the domestic interest is back now. And over the last few days, you've suddenly seen that the broader markets are actually doing well. And the point you made that earnings haven't been as bad as expected. So as of now, would you be tilting towards the mid and small caps that actually took a hard hit, or would you stick to the large cap names?
So Nigel, actually, we didn't really back off from the mid cap and small cap space as much over the last some time. We've been through the thick and thin, and we also probably were not in the camp where we believed in terms of taking those cash calls and stuff like that. So I think generally we don't do that under most market circumstances. So I think that has kind of probably helped us to recover quite quickly, especially in this recent rally. So at our end, I don't really think there's been much of a change. At the margin, probably I would have thought that our mid cap and small cap exposures would have only gone up in the recent few weeks or a couple of months. We continue to ideate out there. We continue to probably find pockets of interest, either growth oriented or probably value oriented. So I think we are pretty much there when we probably have only gained at not having actually disrupted the balance of our portfolios despite the volatility in the market.
Tahir, for mid caps, obviously it's usually always bottom up. But in terms of a theme or, some sort of a segment within the mid-cap or small-cap arena, is there anything where you see clear visibility, something that excites you right now?
Well, I think basically at one level, we are probably a little more positive on NBFCs, for example, to some extent. That is where we probably find opportunities in the mid-cap space. A few pharma companies, that is something which also probably is interesting. Some of the industrials have actually also done well, both in the mid cap, in the mid-sized market, as well as some of the larger cap names have also done well. More particularly, we all know defense has actually made a roaring comeback. So even there, we have a few mid-sized entities as well. So I think these are some of the areas which I believe have where we have probably increased our exposures. I think mid-cap tech, especially in the more recent decline, has also offered some opportunities. Maybe not as much on mid-cap, perhaps mid-cap as well as some small caps too. I think have also helped us out there, and that is an area we have looked at least from a valuation standpoint or a value standpoint, especially after the correction which happened post April 2. So I think these are the few spots where we probably have added to our exposures and weightages.
Okay, what
Sorry,
about...
just one question. On mid-cap tech, is it the IT services companies or would it be some of these ER&D companies like a KPIT Tech?
It's largely been the IT services company.
And you would go back the high growth ones? Because there the valuations are relatively expensive.
They have been sticky. Valuations have been sticky, but delivery has been reasonably strong in some of those names. So we have continued to back some of those. Perhaps some of the, as we've gone down along the tier, some of the small cap entities have also probably taken our attention. And it's not as much because they've done well in the last quarter, but looks like at least that they've had specific factors which have affected them. Probably looks like the worst is behind them. Some trends which are emerging, which seem to suggest that the next few quarters should turn out to be better. And then, of course, valuations have been supportive. So I think that is where we have basically set our sights.
Got it. Final question before we let you go, Tahir. I think real estate was a pack that you liked, earlier.
Real estate, right?
Real estate, yes.
Yeah,
You're maintaining a positive bias. And if you could tell us at least geography-wise, you're very more bullish?
So I think so I like real estate and especially after this correction, I think real estate is an area which I would still prefer. I think as we see decline in interest rates, that should be further supportive. By and large, from a more structural standpoint, we believe that this sector is still in its relatively early stages. I would say we have another 2-3 years to go at least for the cycle to hold itself. We've not necessarily gone by geographical preferences because quite a number of the companies that we own have their anchors in certain specific areas, locations, whether it is south or north or perhaps east. But largely, we've looked at them from a perspective that which are the ones which, if they try to become pan-India players, should be relatively easier for them to do so and should be able to extend their presence in other locations. So that has been the driver, that has been the driving theme as far as a stock selection in this space is concerned.
Okay, all right. Final question on consumption. You'll be leaning towards discretionary, I think so. Are
Yeah,
you
we have a
changing
fair
that
bit of
around?
discretionary, within which I think we would have probably, altered a few choices. Noting the fact that, we are probably likely to see some deceleration as far as urban-centric consumption or discretionary growth is concerned, and a pickup on the other side as far as rural is concerned, or perhaps value retail is concerned. So there would have been some shift in that regard. We would have added to a few value retail, segments, and probably also a few of them which are basically in things like QSR, etc. Once again, a little more tier 2, tier 3 driven. So that's where I think our incremental choices have been. But once again, it's a fairly decent mix. At the margin, we have probably moved more towards some of the value retail stories.
Tahir, it's interesting you mentioned QSR. I was looking at numbers of Westlife, came out with numbers, I think, yesterday. And even companies like Jubilant, finally, those numbers have started looking up after many, many quarters. So the entire QSR space, or, this restaurant space, food space, so to speak, how are valuations here? Now the numbers, the earnings seem to be catching up, at least they're not as bad. Is there a further runway ahead? Because we all know the big talking point, of course, has been this additional 1 lakh rupee in the hands of people thanks to the income tax cut, and whether that is going to boost demand further. What's your sense?
So obviously, valuations are not of the type which are mouth-wateringly cheap. But basically, I think quite a number of these names have been at the bottom end of their business cycle itself over the last 2 years, primarily because a larger part of the incremental growth in many of these do come out of the non-urban centers, and the non-urban centers have probably been a little, slow over the last some time. But things are probably likely to change. Perhaps if we get a good monsoon, interest rates are already coming down, inflation is coming down. That probably gives a little more space for discretionary spends to go up in the mass segment of the income pyramid, and that is probably what will drive incremental growth, if at all, for some of these QSR companies. So that is where we are basically laying our bets and trying to play that segment.
Tahir, great conversation as always. Thank you very much for joining in. Now, as promised, let's invite the management of Tata Power. Now, Q4 was a good quarter for them. There was an improvement in margins. Profitability too was higher. We have with us Praveer Sinha, Managing Director and CEO at Tata Power, now joining in. Mr. Sinha, morning. This is Reema here. My first question is on your capex. Now, FY26 capex was about 16,200 crore, while you had guided for 20,000 crore. So what led to the shortfall? Was there a delay in capex spend? And what can you guide on capex going ahead?
Good morning. Thank you for having me on your show. You're right that we had planned a capex of 20,000 in FY25. We could complete nearly 16,200 crores during the year. Some of our projects got delayed, especially because the evacuation lines for renewable projects, they got a little deferred, which of course will happen in the Q1 of FY26. Similarly, some of the projects of our transmission lines, which we are executing, there were issues about right-of-way, which now have been sorted out and will get completed in this quarter and next quarter. So I think it's just a question of timing, and we are very much on track to complete all these projects that have been planned last year and planned for this year.
All right, Mr. Sinha, hi, morning. Thanks very much for joining. And yeah, I guess that was one of the reasons behind the drag, right, at the top line level. On renewables, can you give us some sense of the revenue outlook? As you're saying that a lot of these issues that impacted the performance in Q4, they'll get sorted out. So what should we expect overall from the renewable portfolio? Give us a sense of the revenue growth, and also in terms of the capacity that you'd be looking to add in this particular year.
So last year we did a capacity add of nearly 2,300, out of which 1,000 was for our own project, that is the utility scale projects that we did. This year we have a much higher target, and those projects will get completed in this financial year. Also, last year we had, for a very brief period, the cell and module plant operating. And of course, the module was for a longer period, but the cell was for a very brief period. With only about 900 megawatt of cell we could manufacture. In FY26, we are expecting that this will cross 3,700. We also expect that our rooftop business, which has now really started pumping up. In fact, in last quarter, we saw the rooftop business doing a PAT of 100 crores. And if that trend continues, then we can expect a very high number in this coming financial year. So I think all these renewable businesses have started kicking in and has started yielding very good result. If you see on year, it was nearly 47% increase in PAT for a renewable business. This year, we can expect similar numbers for growth. So I think what you would see is a very stable performance from our renewable business. And there's not only the utility scale, but also in terms of manufacturing and rooftop.
Okay. Speaking of renewables, on solar, I don't know if you're looking at exports right now at all, because the big headline in the quarter was the US imposing these humongous tariffs, right? It was almost, I think, some 3,000% or something on several ASEAN countries on, solar cells and modules, etc. Does that open up an opportunity for you at all on the solar side, exports?
Right now, we have our commitment to our own projects, which are supposed to be DCR projects. We have commitment to rooftop, as also some of the third-party EPC that we are executing. And we expect that we will complete most of them in next 6 months. And thereafter, possibly, we'll look at the opportunity of exports. But I would like to only say that there are great opportunities within the country, even for third-party sale of just modules, because the DCR has kicked in various businesses, and there is a need of DCR modules. So I think we will weigh the options, whether it makes more business sense for selling within the country or we should export certain quantity. But we'll take a call maybe in the second half of the year.
But are you facing more competition, sir, in this particular segment? Some analysts are pointing that out, which has led to lower market share for you.
I don't think there is much of competition because the cell manufacturing is still very low. We are actually one of the biggest in the country in terms of cell manufacturing. And while a lot of capacity is expected to come in next 1 to 2 years, for immediate future, I would say that we have a very, very good market share. We'll be able to cater to that.
Okay, let's talk about the Discom business, Mr. Sinha. I believe Odisha is working out very well for you, and that's partly responsible for the strong margin improvement as well that we saw in the fourth quarter. Tell us a little more about trends from the Discom business for FY26. What should we expect? And the one that's of maximum interest for everyone, UP. What are the timelines there? I mean, I think you've expressed your interest in bidding as it opens up, but what are the timelines we can expect?
So Odisha has been a great experiment for us, and the type of service improvement, whether it is in terms of reliability, customer service, all that has improved tremendously. And many of the legacy issues which were there in terms of billing collection, we have been able to sort that out, including old payments which were due, but we were not earlier able to collect. Most of it we were able to collect in the last quarter. And this trend will continue because now the processes, systems, the IT support that is required for doing that is all very well established. And I do expect that Odisha will do much better result in the coming year because what we have seen in the Q4, similar type of results we can expect in the coming year, quarter on quarter. On UP, I think the government over there is very keen to pursue this opportunity of privatization, and the PPP model, as has been done in Odisha on similar lines, we expect the bidding process to happen. From what I understand, they have already appointed a consultant and the bid documents are expected in this month end. And possibly in this calendar year itself, the bid will get finalized. And Tata Power has the unique experience of both doing this type of distribution work in urban areas as well as rural areas, which many of the other private entities do not have. And I think we have an edge compared to anyone else.
So just coming back to that margin point, at the end of the fourth quarter, your EBITDA margin has moved up to as high as 19%. I guess the solar business is powering that. The Odisha Discom business is powering that. Is that level sustainable? Can you give us some sense of the margin profile that we can expect this year, maybe first half of the year or the year as a whole? And whether, UP, if you get it, would it become a drag at least in the initial phase?
Well, we have seen that UP will come only in the later part of the year. But the margins that we have been able to improve, this has again been sustained over a period of time. And you have seen that every quarter we have come back with an improvement in our margins. And these are on very strong foundation. This year, our performance of our core business has been exceedingly good. And that is what is the big change that you would see in Tata Power, that how our core businesses have started now yielding very good result. And that's the way it is expected to be in future.
So, for a long time, you've always said that you're committed to not expanding your coal portfolio. You want to phase out your current thermal portfolio as and when the PPAs expire. And the end goal is that you should have zero thermal exposure by 2025. So while you'll still achieve it, but you are stating or indicating that you've not ruled out any opportunistic bid for stressed thermal assets. So the question really is that in the interim, what is going to be Tata Power's thermal strategy?
So as we have been maintaining, many of our PPAs have an end date. And as and when those end dates will come, we will definitely like to decommission those plants. And we stand committed to that. Secondly, we do understand that there is also in the short term a requirement of energy security. And if there is a very good proposal which is there, we will examine it. It's not that we have committed, but we will definitely look at it. If it meets our overall objective that by 2045 will become net zero. So that date does not change and our commitment of 2045 does not. In between, if there is something that comes up, we can consider them on merit.
Okay. All right, Mr. Sinha, thank you very much for joining in and giving us some perspective on the business. Wish you good luck for the rest of the year. Well, that's Tata Power talking about going ahead and probably looking at the UP Discom as well after the success that they've found in Odisha. Stocks down about 0.5% at this point in time. Well, we're staying with the industrial space. The next company on our radar is Hitachi Energy. The fourth quarter performance was another pretty strong performance, especially on the operational parameters. The margins were a beat on expectations, and the order book has seen a growth of 166% and profit has also increased. We have N. Venu, Managing Director and CEO at Hitachi Energy, now joining in. Mr. Venu, thank you so much and congratulations on another good quarter. Now, some will quibble and say that your top-line growth in Q4 is not as strong as what you've done historically. The top-line growth, I think, is about 11%. But obviously, those margins at 12.6%, they're looking spectacular. I'll start with the one main question. This HVDC order that you've bagged, this was a big announcement over the year that's closed out. Now, what is the revenue recognition timeline? I mean, over how many quarters? When does it start coming in? Yeah. And therefore, when will it start leading to, stronger revenue growth?
Sure. No, I think thank you very much having you in your show, and good morning to all of you. And as you have seen, our results, strategic focus, and also cyclical trends delivered a very strong quarter in a Q4. And if you really let me give a 30 seconds deep dive of our results. And our orders are up in the quarter almost 56%. Our revenue are up by almost 13% on year-on-year basis. And our margin in the quarter is up by 62%. And our operational EBITDA came double-digit, 12.3%. And this is also our full year performance. And if you really take the whole of year, our orders are up pretty strong, 228%, primarily bagging HVDC order and others as well. And revenue is up 23%. Yes. Whole year revenue up is a very strong orders. And we have been consistently saying in your own channel that we have been growing higher than the market on the top orders especially. And then once we have the order backlog, so naturally it will convert into a revenue over a period of time. And that's exactly happened in that. But if I come back to your specific question on the HVDC order, which we have
the recognition. Yeah. So we just want to understand, I mean, just for the benefit of our viewers, the revenue that you did in FY25 was 6,385 crores.
Right.
And your EBITDA margins were already at a multi-year high, 9.3%. So we just want to understand that as the booking of this HVDC order starts, how will the FY26 P&L profile look like? Revenue, margins, how does it change?
Yeah, as you know that we don't give you a forward-looking statement, but let me give you a little bit of marker so that you understand that. We have been consistently saying that we will reach a double-digit margin by end of this financial year. In the quarter, we already reached here. And we said we will sustain that. Quarter by quarter can differ. But on an overall year, if you really look at the FY26, we said we will do a double-digit margins on that. Our HVDC's revenues this year is going to be very small revenues. But in the year 27 and 28, we're going to have a bulk of the revenues we're going to realize in these two projects in that.
Okay, so even without the, it'll be a very small trickle of the HVDC boost that comes in this year. Yeah. Even without that, you're saying margins will be in what, low teens? When you say double digit, what does that mean? Low teens, mid teens, some range?
We don't want to give a thing. I said we'll enter double digit and we'll sustain there. But again, I'm saying quarter on quarter might change. But on a year wise, if you really look at an overall year basis, so we will I think sustain the double digit.
Okay. All right, Mr. Venu, good morning and good to see you, Ben. You can focus on business, but the markets seem to sometimes take into, factor in valuations. Could explain why the stock is down 4% or thereabouts, but the performance has been good. Now, on your order book, you have disclosed it at around 19,250 crores, right. But you have not factored in the second HVDC order from the Adani Group, because I think that was signed in April 2025.
Absolutely right.
This will be accounted for in the first quarter of 2026. So if that is the case, back of the envelope calculation suggests it could be around 11,000 crores, which means your order book could be around 30,000 crores. Am I around about the correct numbers?
Yeah, if you, the other order in the ballpark of 8 to 10,000 crores. So if you add that, so naturally it will be there.
Okay, all right. So around 30,000 crores, 30,000 crores is what we can assume, going by what you have disclosed and what you will disclose at the end of quarter one. Exactly. That's out of the way. Now, services is a smaller part of your business, but you've separated that as well. You've put it on, in your numbers. Yeah. How big can services become as a percentage of your business? And also exports, that's the other one that drives business, right? How much will services scale up? How much can exports contribute to the pie? Because they are both margin accretive. Go ahead, sir.
So on there's two other levers for our growth, as well as both top line and bottom line, as the services and exports we have been consistently saying and consistently driving. Services right now is a single digit, and we have plans to take it to the mid-teens, maybe double digit. And we also talked about previously that the potential is based on our install base. We have a close to 2,000 crores order book possibilities there. It won't happen overnight, but we are looking at anywhere between 3 to 4 years' time. Today, we are around 500, 600 crores level of the service in that. So there is a potential. On the exports, if you take a last year exports without HVDC, our exports are in the 30-35% of our total orders. And we have been consistently saying that we would like to, in the range bound of 25-30%. We are already there in that. But we will add more and more exports. But our key focus is going to be a domestic market. We see a lot of pipeline, very huge pipeline, and not only on the renewable, but also on the transmission, but energy storage, data centers. All those things are a huge tailwinds for us. I think we are focusing. And you all know that we announced a 2,000 crores capex, and as we speak, and many of these projects are underway. So this will also add to increase our installed capacity in India.
In fact, I wanted to talk to you about your capex, 2,000 crore over the next 4 to 5 years. I think the cash in the books now is 3,800 crore. Is that correct?
Right.
So what lines are you adding capacity in? What will be the incremental revenue, the margin potential from your capex, and when will it come on stream?
Yeah. So again, it won't happen overnight. So we are talking about a 4 to 5 year thing, and there are many projects we are taking. For example, some of our large power transformer capacities. We are adding some of the very critical components required for the transformer insulation material, so that we are expanding it. Some bushings, we are expanding it. Some of the new technologies, first time we are bringing it to India. For example, HVDC bushings is a very, very clear component, very important component. We are bringing those things. So these are all coming in a phased manner. And generally, our asset turnover is in the range of, 3 to 4 times to start with, because they're quite a big capex, and then afterwards it might go higher in that. So it is coming in a phased manner, and we are on track as far as our planned capex is concerned. And we see that in the next 4 to 5 years we complete what we have committed, what we have promised.
Just a quick word on the data center opportunity. Will you be able to quantify?
No, data center is quite a big opportunity. Every data center.
But for you, will you be able to put a number to that? We know the total addressable market is huge.
I'll tell you, our addressable market in every data center cap is 15 to 20%, depending upon the hyperscale. Every hyperscale coming into the picture, 15% of the data center capex is our addressable market.
And how much will you be able to realize?
As we speak now, every 1 out of the 3 data center is powered by us, especially on the grid connection and on that. So we are looking at to maintain that our market share.
Mr. Venu, I'm just going back to HVDC for a second, sir. This 30,000 crores of rough order book, if we count in the April, so as of today, if we talk about it, roughly 30,000 crores. Yeah. What is the split between HVDC and non-HVDC as of now? Just percentage, rough percentage.
As I said, as we speak, as of end of this last financial year, our order backlog is 19,245 crores, and the new order we have booked only in the month of April, so which we're going to tell you after the end of the quarter closure. But on the 19,245 crores, is the only one HVDC is sitting in this thing. The rest of the things is non-HVDC, like your data center, industrial things, services, exports, etc.
No, what I'm trying to now get at is that two-part question. FY26, what is the, and you'll eventually book this one, and I don't know if the third HVDC order, whether that comes up for bidding this year itself or not. Just tell us that. And, by the end of this year, what will your mix be between HVDC and non-HVDC?
No, we don't do that way, mix, because HVDC is also one of our levers. It's not the only one, because take, for example, HVDC, all our 4 business units portfolio go into this particular project. So that way, we don't make separate HVDCs are separate, and that way we don't treat that.
You don't bifurcate that. Okay, and I get your point that FY26, you said it'll be a very small, quantum of revenue that will be booked. If you could give us some sense, and then just give us some sense of FY27, because the market discounts the future, right? We're just trying to understand that from a P&L standpoint, what kind of revenue will be booked in FY27 from this large HVDC chunk that you have? Let
me give you a little bit of marker for you to understand. The HVDC projects normally we complete in 48 to 54 months. So 48 is the first bipole, and 54 is the second bipole in that. So normally in the first year, we do a lot of engineering and the small revenues. So that will be very small percentage, low single digit in that. The second year will be slightly higher, and the third year is where the bulk of the revenue comes in that.
So FY28 is where the bulk of the revenue comes
27
in.
Also, 27 second half also is quite a thing, and 28 will be definitely much higher.
All right.
Understand these 2 projects has around 6 months delay, so naturally that particular revenue delay also will be there.
Okay. All right. Mr. Venu, very quickly before we let you go, small nuclear reactors, well, that's been in focus in India as well. Now, your parent, Hitachi, has globally very strong nuclear capabilities. If and when this opportunity opens up in India, will it be pursued under the listed entity, Hitachi Energy India?
See, Hitachi Energy India, what we do is whatever is required for the, this nuclear thing we do, but not on the technology standpoint, is a separate company.
Okay, so then it would not entirely come under this entity, right?
Yeah, but what is required for that, powering the nuclear thing, like offshore and auxiliaries, etc., will come from us.
Okay, all right. We'll press you a little bit more on this, but thanks a lot for joining in. I recall when I visited your unit, you all were gunning for double-digit margins. Now margins are improving. Exports and services are going to be a larger share of your contribution, which will help profitability. Thanks a lot for joining in, Mr. Venu. Looking forward to chatting up with you as the year progresses. For the time being, slip into a short break. On the other side, we'll be joined by the management of Muthoot Finance. Stay with us.
Welcome back. Now let's invite the management of Muthoot Finance. The stock is a bit under pressure despite a decent set of Q4 numbers. The AUM saw a growth and they've maintained their gold loan guidance for FY26. George Alexander Muthoot, Managing Director at Muthoot Finance, is now with us on the show. Thank you very much for joining in. Well, sir, you're talking about a minimum growth of about 15% for FY26. You have also kept the option open that you will revise it higher. But, considering that you achieved a 40% growth last year, a minimum 15% appears to be a bit conservative. Tell us what's gone into this guidance and what could be the realistic number. Already we are halfway through Q1.
Thank you. Thank you and good morning. Over the last, maybe to my remembrance, maybe last 10 years, you've always been giving the guidance of 15% only. But always we have been achieving 20, 25, 30, and last year 40%. So it is just a number that we give in the beginning of the year. Probably we will revisit it. We will look at it probably after Q2. We will revisit the guidance number also. But the market is good. The business is good. We see good growth coming in this year also.
Are you worried that a lot of your AUM growth is driven by the rise in gold prices? If gold prices retreat, and we've already seen gold prices come down, cool off a bit, is there a risk to your AUM growth? On the AUM front, how are you seeing this volatility surge, then risk of a cool off in gold prices? And what could your AUM guidance be?
Yeah, there are always fluctuations in gold prices. Maybe goes up, goes down. But over the last years, it has always been going up only. But of course, in the last 6 to 7 months, it has gone up too high. Probably it may cool down a bit. But of course, we give only 75% of the current value. And that also is a 30-day moving average. So today, if you look, our gold loans advance which are given, it's only 62% of today's price. If you look at the value of the gold we have with us and today's gold price, it's only 62%. So that is the margin or the headroom we have. So some corrections in the gold loan will not be affecting us. Second, as always, we have seen so many such cycles. We have seen the cycle of gold price fall in 2013, 14, and occasionally over several years, you see some months of gold price fall, etc. But people don't abandon their gold. So gold price is not a big factor. But having said that, why the business is going up is mainly because of the demand for funding. The unsecured loan sector is the people are not getting the money they required. So people are using gold loan and banks are also doing it. The pie is increasing. More and more people are actually looking to gold loan for a quick and easy finance. That is why business is growing. Of course, gold prices help because they don't need to bring extra gold. With the same gold, they can get more and more money.
Okay, so as of today, as on today's prices, you're maintaining about a 62% LTV, right? So we got that.
So I think not the exact number, maybe 60,
around that.
What we have given,
around 60%. So give us a sense. I mean, the fourth quarter, obviously, it looked absolutely. It was an outlier, 40% growth in AUM because of the way, gold prices move. But steady state, what is the AUM growth in the loan book that you're expecting on the gold business this year, FY26?
That's what I have been saying. We will get good business, but don't be carried away or don't be concerned with the ultra conservative guidance which you are giving. We have 5,000 plus 6,000 branches in Muthoot. So people are there, the money is there, the requirement is there, our branches are there, staff is there. This will go up only.
Okay, so you're just being conservative. You're admitting you're being conservative at 15%. All right. So just a word on cost of funds as well. How is that moving? Because I think for you, the NIM quarter on quarter, there was a little bit of a pressure that was coming in. But now there are a lot of moving parts. I mean, we are in a rate cut regime from the RBI as well. What are you expecting on cost of funds and NIMs over the next couple of quarters?
So we have been maintaining our spread. NIM should be about 11%. Spread should be in the 9.5%. I think in the last 4 or 5 quarters, our spread has always been 9.5, and we actually maintained it. If the cost of funding goes up, we try to absorb it for 1 quarter or so. Afterwards, it's still going up. We increase our yield, but we maintain our spread. The same thing if the cost of fund. Today, the cost of funds is coming down a little. So it will take for a few months for it to maybe stabilize. If it is really coming down, we will reduce our yield, but maintaining our spread. So if there is an advantage in the borrowing cost, we pass it on to our customer. That is what our NIM and spread, etc., have been almost constant in the last several quarters.
You just spoke about
the cost of operations. Yes, the new guidelines.
Go ahead.
All the new guidelines, the compliance cost is also going up. But only advantage with Muthoot is that our per branch business is also going up. So in that respect, our cost of operations will stabilize. So last year, our per branch business is about 15 crores. Today, it is about 21 crores. So that will help in maybe absorbing some of the extra, compliance cost, etc.
Can it go higher than from this 21 crores? If yes, what is the kind of outlook?
Definitely, it should go up. That is why we are all here.
To what? To what level, sir? If you have a target, as you're saying, you've been ultra conservative, stock is down 5%, you're on the best business news channel and everyone is hearing, you can go ahead and up the guidance as well, sir. Do you want to do that?
So I think a branch, it was 15 crores last year, it was 21 crores this year. I'm sure we have branches with 50 crores, 60 crores, 70 crores also. So optimistically, all the branches can reach 50, 60 crores.
Okay, all right. But you want to up the guidance from 15% that you've given conservatively?
Not today, sir. Maybe after Q2.
Very quickly, you mentioned about yields. There could be some pressure there because competitive intensity could come back. PSUs, banks, they are eyeing this gold loan market share as well. And now Manappuram, that's been, not really a big competitor to you. They could pull up their socks because Bain has come in. A quick comment on competitive intensity and could yields come down from the current levels? I think it's ballpark around 18%.
I think I just mentioned that if the cost of fund is going up, we will increase our yield because these are all small loans. The 20,000, 30,000, 50,000, 1 lakh, a 0.5% increase in the yield will not maybe change the sentiment of the customer because it's a quick loan, short-term loan, 2 months, 3 months, 4 months. So in absolute terms, the interest payment is not much. So if the cost of fund is going up, we actually increase our yield. We have been maintaining our spread and net interest margin spread of about 9.5% is what we have been maintaining all the way. And we should be able to maintain that. Competition intensity is there. It is because this is a good sector. Everybody wants to enter there. But the pie is also growing. It is not that we are the only ones who are growing at the cost of somebody else. Yeah. Banks are also having 20, 30, 40% gold loan in their growth in their gold loan portfolio. So if everybody is growing, the market is increasing, sir.
Okay. All right. Good speaking to you, Mr. Muthoot. You're not taking the opportunity this time around to go ahead and increase your guidance. We'll chat soon. Maybe that's the time you'll go ahead and up it. Appreciate you joining in. Let's focus on the cement pack then. We have Neeraj Akhoury, the Managing Director at Cheese Cement, who joins us on the show. Hi, Mr. Akhoury. Good morning and congratulations on a good set of numbers. What's the strategy going to be, sir? Volume growth actually has been lagging the industry, at least in the past year, but pricing has improved and profitability has improved. For this year, what kind of a volume outlook do you have? Point number one. And premium as a percentage of your trade mix, that's moved up. Where is that number headed from around the 15% mark?
Good morning. I think as we always have liked to believe that the cement demand growth would be in line with the GDP. If we are expecting the GDP to grow by 6 to 7%, then to my mind, cement demand growth will also be around that, 6 to 5%, 6 to 7%. Yeah. For us, we would be adding some new capacities this year. We have already added 2 plants this year, and we will be adding 2 more in the coming quarters. And that should give us a volume which will be slightly higher than the industry average, industry growth. That is how I see. On premium, we have been working on it. We've already reached from 9% to roughly about 15.5% now. And this trajectory will continue. We expect it to touch somewhere around 17-18% soon. That is a trajectory that we have decided. The focus is on profitable growth. The focus is on is how to make sure that our efficiency parameters as well as our pricing works well for our results.
Okay, so high teens is what you're gunning for in terms of premium as a percentage of your trade mix. Got that. And on volumes, we are working with 6-7% growth for the year, a GDP growth that is 6.5% or thereabouts. So, and normally, as you said, cement grows at a faster clip. So for your company, sir, after underperforming in the last year, this year, fair to assume 9 to 10% volume growth?
No, I would rather keep it at 8% for now.
8%, you're being conservative because I'll hold you at this number as well the next time around you join in. Got that. On the cost side, you have been, focusing a lot out there. And if I look at it, green power, the share is at around 60%. It's the highest in the full industry. And that's moved up. Where do you see this number headed? And since you have cost levels in place, what does it mean in terms of an EBITDA per ton? For the year, you were at around 1,000 rupees or thereabouts. This year, what is the range we can work with?
So it's not right to give me an estimate like Nigel, but I would say that given that we are having better prices than what we had last year in the same quarter, along with the fact that some of the costs continue to decline, including the fuel prices, we expect that the fuel prices will at least remain at this level and not go up. In that case, I would say that the EBITDA would be should be better than what we have seen for full year last year at 1,000. But we'll not be able to give an exact number at this moment.
And DAM Capital is saying by FY27, they're expecting the number to go to 1,370. You agree?
Let's see. It's too early in the year. It's just quarter one of the full year. Let's see.
And green power is a percentage of the mix. Where does it go?
We are working a lot on the green power, and 60% is what we have achieved. Happy to note that we are one of the best in the industry, most probably globally as well. And I would expect this to go up. We are already working on some more sites across the country, so it should go up in the coming quarters.
Mr. Akuri, you all will have to do something more exciting now, because I mentioned this to Mr. Bangur as well. Shree Cement always gets the best valuation in the full cement pack, because of the ROC. You all were the first ones to get into pet coke, all that taken on board. But Street is looking for something more exciting. What is that going to be from here on? You're sitting on cash of around 5,400 crores, which is a good amount. You have a capex plan of around 3,000 crores for this year. Some kind of inorganic growth could be the trigger. Are you looking?
Nigel, as I said, we are very intensely focused on being the most profitable cement company in the industry. And that is something that we would like to fiercely protect in the coming quarters and coming years as well. We have a lot of plans on organic growth. We have a plan to reach 80 million tons by FY28. And with that ambition, I think through organic routes, we will reach there. We are not against any inorganic growth. But it should make sense to us in terms of valuation, in terms of strategic fit. But currently, the focus will remain on how to reach 80 million tons on the organic route.
You have, you're currently in that vicinity of around 60 to 63 million tons.
Yes.
And I think what's on the drawing board is to reach 70 million tons. So from 70 to 80 will all be organic. Is that part of the plan as of now?
Yes, absolutely.
And you mentioned a couple of times that profitable growth is something, you want to be the low cost producer and in turn, focus on profitability. But if it's a toss up between profitability and volumes, what you'll choose? Because last year volume growth was very, very low. It was low single digit and you lagged the industry. So a toss up between the two, which one are you selecting, Mr. Kuri?
We are very clear that value is what we should be chasing and not just volumes. Volumes are important, but at the same time, we would be following that. How can we get more profitable growth and not just volume growth?
Okay, all right. Profitability over volumes. We got that on board. We'll hold you to a few of these numbers. Thanks a lot, Mr. Kuri, for joining in and detailing those set of numbers and the way ahead.
Pleasure.
By the way, when we're having the chat with the managements of Muthoot as well as Shree Cement, the markets are actually down close to under 150 points. Number of stocks advancing still more than the number of stocks declining, though in fact the mid-cap index is almost moved into the red. Slip into a break, come back. Manisha Gupta will be joining in to tell us what's going on in the commodity space.
Welcome back. Down 0.5% now on the benchmark indices. Let's find out what the situation is in the commodity markets and what the rates look like. Manisha.
Thank you for that, Rima. It's profit-taking across commodities as well. And I want to start with the gold prices because we saw all-time highs here when we saw those tariffs come in, and $3,500 an ounce of an all-time high is what the gold prices hit. Well, since it has been US and China trade agreement, even if it's temporary and for 90 days, we have seen that constant profit-taking continue in case of gold prices. So 3150 and below that is how the gold prices are trading now. It is a 5-week close coming in for the gold prices. Let me still remind you that for the year, we are up by nearly 24%. And for the last 12 months, it still is 40% higher for the gold prices. But from its all-time highs, the gold prices now have declined by nearly 10%. So huge profit-taking coming in, and this is in less than a month that we've seen the gold prices see that kind of a decline there. Well, one is, of course, the focus has shifted away from the safe havens. It's risk on, and we've seen money flow into various other asset classes. And majorly, it is profit-taking because the street believes that various cues, the reason that the gold prices went higher, seem to be easing off now. One, of course, is the US and China trade tensions, though it seems to be diminishing right now. And then the US also has been reiterating that the trade agreements are processing well from various countries like India, Japan and South Korea as well. The third point really is about Trump lifting sanctions on Syria. This was announced in Riyadh when he was visiting Middle East, and that also has eased pressures a bit. It also is about India-Pakistan tensions not escalating, stabilizing even. And then it also has to do with the softer than expected US inflation numbers that also have led to this decline in gold prices. But it's not just gold. If you look at silver prices, they also fell 2% in the overnight markets. We are trading at a 1-month lows for silver as well. So when you look at on a week-on-week basis, we have seen the gold prices decline by 5% and silver is down 2% in the same time as well. And it's not just about the precious metals. The industrial metals also have seen a sharp decline. Whether it is about copper, aluminum, zinc, we have seen prices decline. And if you look at the crude oil prices, there has been a very sharp cut coming in for this as well. It has been 2% of a cut on 2 days now come for the crude oil prices. And with that, now we are off those 2-month highs that we were trading in. Well, the major factor here also is that Iran has said that they are ready for a nuclear conversation. Remember, there has been 4 rounds of talks there. And Iran also says that once the sanctions are taken off, they can talk about nuclear deal here. So there seems to be some progress in conversations coming in there as well. Apart from that, when you look at the US crude inventories, well, they also have seen a surge by 3.5 million barrels. Street was anticipating a 2 million barrel of an increase, so that has been weighing. And then you have the OPEC trimming supply growth from non-OPEC countries, suggesting that if the crude oil prices stay where they are, then for US and for the non-OPEC countries, it wouldn't be very profitable to continue to produce crude at these current levels. And then US OPEC and oil supplies also have been increasing, even as OPEC is looking to increase production for the month of May and June. We have seen some internal disparity not continuing to work there, and that seems to be weighing onto the markets there. So whether it has been about precious metals, industrial metals, energy prices, all of that has started Asia on a weaker note today. What the markets will want to watch out from here is the US PPI numbers, and that would give you further direction from here.
Thank you very much for that. And Reliance Industries Chairman and MD Mukesh Ambani went to Qatar to meet the US President Donald Trump, who is on a tour of the Gulf nations. You can see the visuals on your screen. Mukesh Ambani also met the Emir of Qatar. This is Reliance's chairman's second meeting since Trump's return to presidency in January this year. Okay, still down more than about 100 points on the benchmark indices. Reliance Industries share price is down more than about 0.5%. Also under pressure, you've got Power Grid, Dr. Reddy's, NTPC. So power is cooled off today. Some of the pharma names are weak. So we spoke about Dr. Reddy's, but other than that, you've got Cipla, and banks continue to tread with weakness. Yesterday, the Nifty Bank underperformed, and today as well, the Nifty Bank is down close to about 250 points. Mid-caps are relatively outperforming. No gains to boast of. The mid-cap index is up 0.1%, but at least there is that relative outperformance. Advanced decline ratio in favor of more stocks advancing. With that, we'll get into a break. We'll come back with our special segment, Indianomics, on the other side, where Lata speaks to Neeraj Seth, CEO of 3R Investments, on Asian currency and credit markets.